Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of the Smart Investor's Guide to the Fashion and Luxury Goods Industry in 2025. LVMH, Louis Vuitton, Moet Hennessy. As the largest luxury goods conglomerate, LVMH houses brands like Louis Vuitton, Dior and Givenchy. The company thrives on diversification, with a portfolio that spans fashion, wines, spirits and even luxury hotels. LVMH has shown consistent growth, largely thanks to strong brand identity, global expansion and its ability to cater to both heritage and emerging markets. Kering, known for brands like Gucci, Saint Laurent and Balenciaga, Kering offers a combination of contemporary appeal and timeless elegance. Gucci alone drives a significant portion of the company's revenue. Kering has focused on sustainability and digital innovation to set itself apart, which resonates well with younger, eco-conscious consumers. Hermes. Hermes thrives on exclusivity with products like the Birkin bag, often having years-long waitlists. Its slow growth model, emphasizing craftsmanship and limited production, has helped maintain its mystique while driving profitability. Shares in Hermes have been a steady performer for years, often viewed as investment-grade luxury. Nike and Adidas. While not traditionally considered luxury brands, these companies continue to gain traction via premium sneaker collaborations and limited edition drops. Their ability to combine popularity with scarcity creates opportunities for high returns. Potential risks. No investment comes without risks, and the fashion and luxury space is no exception. Some factors to keep in mind include economic sensitivity. Luxury goods are often among the first to feel the pinch during economic slowdowns. Discretionary spending cuts can impact sales. Counterfeit goods. The prevalence of fakes can dilute brand value, especially for high-end labels. Market saturation. Over-reliance on one region or demographic, e.g. China's affluent middle class, can pose risks if those markets slow down. As an investor, it's critical to study annual reports, track market trends, and stay updated on geopolitical issues that could impact global luxury demand. Private equity and venture capital investments. For those looking to go beyond the stock market, private equity and venture capital offer unique entry points into the industry. This approach often targets emerging brands or innovative companies seeking to disrupt the traditional fashion and luxury space. Where are investors putting their money? Emerging designers. Backing breakthrough names in the fashion world can lead to high returns if the brand gains traction. Investors often look for bold, creative talent that can carve a niche in the market. Sustainability and tech. Brands that focus on eco-friendly practices or incorporate advanced technologies like AI-driven personalization or blockchain for tracking authenticity are rapidly gaining attention. Startups developing new materials or recycling methods are particularly attractive to investors. Direct-to-consumer (DTC) models. DTC brands like Everlane and Rent the Runway have sidestepped traditional retail routes to build loyal customer bases. Their reliance on e-commerce minimizes overhead while maximizing engagement, making them appealing for venture capital. Resale and circular fashion. The second-hand luxury market is booming, with platforms like The Real and Vestiaire Collective leading the charge. Investors are drawn to these companies as the resale trend aligns with growing consumer interest in sustainability and conscious consumption. Why the stakes are higher? Private equity and venture capital investments can offer impressive returns, but they come with higher risks. Identifying the right opportunity requires thorough due diligence. Here are some considerations. Market positioning. Does the brand stand out, or is it entering an already crowded space? Unique selling points, USPs, matter. Scalability. Can the business grow without losing its identity or value proposition? Not all small brands are equipped to go global. Management team. A talented, forward-thinking team can be the difference between a good idea and a profitable company. Investors must dig deep here, analyzing everything from supply chain efficiency to brand loyalty metrics. While it can be tempting to get caught up in hype, a measured approach ensures you don't overpay for potential. Why it's worth exploring. Despite the challenges, the rewards can be enormous. Private equity firms like L. Catterton, co-owned by LVMH, and individual angel investors have hit it big by backing companies at the right stage. For instance, L. Catterton has invested in beauty giant Il Makiage and activewear brand Sweaty Betty, both of which have shown strong growth in emerging market segments. Whether you're intrigued by the future of fashion tech or captivated by the exclusivity of up-and-coming luxury brands, private investments can unlock doors to new opportunities that go far beyond the public market. Make sure you have a clear risk tolerance and long-term outlook before diving in. Analyzing the financial health of fashion companies. Investing in the fashion and luxury goods industry requires more than just an eye for style. It's about understanding the numbers that drive success. Financial health determines whether a company can grow, withstand challenges, and deliver returns. By focusing on key financial metrics, investors can better assess which companies are worth their attention and dollars. Key financial ratios and metrics. Evaluating the financial health of a fashion company means digging into specific ratios and metrics that uncover strengths, weaknesses, and potential risks. Here are the most important ones to know and how they apply to the industry. Price-to-earnings (PE) ratio. The PE ratio is a classic measure of how much investors are paying for a company's earnings. In simple terms, it indicates whether a stock is overvalued, undervalued, or priced just right. How to interpret it? A high PE ratio often signals that investors expect strong future growth. This is common with established luxury brands that have a track record of consistent expansion, like Hermes or LVMH. However, if the ratio is too high, it could mean the stock is overpriced. Conversely, a low PE might suggest the stock is undervalued or the company is facing challenges. Industry insight. In fashion, a higher PE is often justified when companies are scaling through international markets or pioneering trends. However, be cautious. Fast fashion brands with high PE ratios may carry risk if consumer habits shift quickly. Price-to-sales (PS) ratio. The PS ratio compares a company's stock price to its revenue. It's particularly useful for analyzing newer or growth-focused companies that might not yet be profitable. How to interpret it? A lower PS ratio may suggest a stock is undervalued relative to the company's sales, while a higher ratio can be a sign of robust demand or overvaluation. Industry insight. For luxury brands, a higher PS isn't unusual. Consumers often pay a premium for exclusivity. But if the ratio skyrockets without revenue growth to match, it might signal trouble. Return on equity, ROE. ROE measures how effectively a company uses shareholders' investments to generate profit. It's calculated by dividing net income by shareholder equity. How to interpret it? A high ROE is a positive sign, showing efficient management and profitability. However, if a company's debt contributes heavily to its equity, a high ROE might be misleading. Industry insight. In the fashion world, high ROE companies often dominate their niches. For example, a brand like Chanel may report strong ROE numbers because of its loyal customer base and high margins. Pay attention to how companies like fast fashion retailers achieve high ROE. It may come at the expense of sustainability and long-term growth. Debt-to-equity (DE) ratio. The DE ratio tells you how much debt a company uses to finance its operations compared to its equity. It's a key risk indicator. How to interpret it? A lower D/E ratio usually reflects a healthier balance sheet and less reliance on borrowing. A higher ratio might mean the company is over-leveraged, making it vulnerable during economic downturns. Industry insight. Established luxury brands typically maintain lower D/E ratios due to strong cash reserves and consistent sales. In contrast, newer brands or those with aggressive growth strategies, like opening new stores or launching collections, might carry higher debt. Know the difference between good and bad debt when evaluating companies. When analyzing these metrics, remember to consider the fashion industry's unique dynamics. Seasonal demand, brand reputation, and the ability to adapt to trends or economic shifts all play a role in shaping these numbers. Looking at these ratios in context, not isolation, can help you make smarter, well-informed decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.